All right, folks, welcome back. This is our weekend commentary for the ICT Mentorship for October 8th, 2021. I'm feeling much better. Thank you for your concerns. Thank you for your prayers. But I'm in good hands. So we have the dollar index daily chart here. And as I mentioned, we could possibly go down to that volume imbalance there. Ended up going into mean threshold of the last down close candle. Most importantly, we did not see it come back down to this high. That's not what we wanted to see. So ultimately, this really hasn't changed the underlying momentum, bias, trend, narrative. It hasn't broken any of that. So I'm still looking for this into next week, as I mentioned, we might see. So nothing has changed. We just had an outside day with a down close. Now, it doesn't have as much importance in my mind when it's on a Friday, but it's also non-farm payroll. So it took out previous day's high, previous day's low, and it went down to a discount array, which is kind of like what we were expecting, worst case scenario, if it went down. It didn't have any kind of reversal that took us back above the opening price, but that's okay. Positions are squaring at the end of the week. It's non-farm payroll typical. But I'm sticking with the narrative that we're going to most likely go up for these buy stops and for the buy stops above here. So I'm still bullish dollar. Dollar index hourly chart. You see here we have these consecutive up close candles. That is your bullish breaker. Okay, so you have a bullish breaker here. Extend that through all this. We traded down into that. Hopefully we'll find some continuation on the upside. I like to see a gap opening on Sunday. Come down, fill in the gap, and then rally, take out the buy side here, here, and here, and accelerate into Monday's trading and Tuesday's trading. Making an attempt to get up into this level here. Do I expect it's going to be a one-day event? No. But that's the narrative I'm working with going into the beginning of next week. Obviously, anything can happen. Bombs could be dropping. Dogs and cats living together. Anything can break out over the weekend, changing this ideal scenario for me. But, we have to have some kind of target goal, plan of engagement. And I'm sticking with this. All right, dollar index, 15-minute time frame. Nice buy side liquidity pool resting right here. Low resistance liquidity run signature right here. And just a drop down to take out sell side here into a bullish breaker. On non-farm payroll, nothing really happened after non-farm payroll event. It just consolidated. So to me, it should have dropped if it was bearish, right? It didn't. Notice that? It just consolidated. It came off the low and then consolidated. That's just squaring positions for the close of the week. They're going to let sentiment ride over the weekend. News headlines, all kinds of things are going to come out. Well, I'm not trying to predict the headlines, but let's say it like this. The sentiment that's going to be building over tonight, all day Saturday and Sunday, and for traders that are chomping at the bit, wanting to get into these markets on Sunday's opening and Monday's trading, they'll probably make a move on that. Now, retail might see this as support broken and maybe looking at this as a bear flag or some kind of a continuation pattern lower. That's wishful thinking in my mind, but nothing has changed here for me. It's just typical end of week. It closed down. And the non-farm payroll event did not create bearishness. Notice it didn't go lower. So that's how I'm interpreting it. Eurodollar daily chart. We trade up into the fair value gap in here. Didn't want to see that, but hey, you get what you get. So we had an up close on the close of the week. And this creates a nice little short-term premium market. And I'm still focusing down here. Nothing in here looks like it's made a low or bottom. I'm not trying to pick the bottom. You shouldn't be trying to pick the bottom. So until we're proven incorrect, or let me say it correctly and own this. Until I'm proven incorrect, I'm sticking with the bearish stance on Eurodollar. Hourly chart, Euro. Okay, small little move overnight and then rallied right off of that. I actually watched this happen. And I was thinking to myself, okay, well, they're probably going to set up a little punch above here, and then sink in on non-farm payroll. Nope, was wrong. Now, before I get any further into the discussion about the charts, which is going to be light, the things I stated this week about, and what I do every week when it's non-farm payroll protocol. Last night I told you that when I was in my early career, in the first 2 years or so of trading, this week, every single month, the Thursday and Friday of non-farm payroll were always where I got it wrong, predominantly. If there was a statistics ran on just that part of my trading, I probably was about 5% accurate. Now, think about what you watched me call and what we were expecting to see. Did it pan out? No. So hopefully you see why I have the opinion and why I have the view on staying out of the market on Thursday and Friday. Now, you might find setups and you might make money, you might lose a little bit of money, and that doesn't bother you. For me, I have deep scars. Okay, so to prevent myself from reliving those terrible moments, okay, and toxic memories, I just avoid it. And some of you may not want to adhere to this and you want to still take trades. If you lose, I warned you. If you make money, I don't want to hear about it because it's not going to make me, oh, let me go back and start doing it again. It's not what I'm not going to be enticed to do it. Okay, so it's discipline. I forged it over a long, long career, and I'm not going to abandon it because it serves me best. It keeps me grounded. It doesn't allow me to look at something and say, well, I need to go in here and take a trade, or my students will think I don't know what I'm talking about. I think this proves that I know what I'm talking about. I know where my weaknesses are, and it's going to take a long time for you to discover where yours are and for you to agree with yourself and say, yeah, that's a weakness. Because most women aren't so, well, they're not plagued with the pride aspects of admitting weaknesses like men do. So it takes a very strong man to admit where his weaknesses are. So if you can identify where they are, why do you want to gamble there? So if I know where this is the majority of the time, the manipulation that will come in the marketplace, and I'm apt to be wrong, well, guess what? Should I be surprised if my prognostication is off? No. And I choose not to tread in landmine fields. You can tap dance all over this if you want, but I want to be around for the rest of the month and the months going forward, years forward, that type of thing. I don't want to be the hero, okay? I'm not Saving Private Ryan. There's no prize at the other side of non-farm payroll for me to do this every single month just to prove I can do it, because I already know I can't do it. And I've stated this very openly. So if I'm telling you I can't, don't email me and ask what I can do to increase the odds, because I don't have anything, okay? If I did, I wouldn't have the stance that I have about Thursday and Friday on non-farm payroll. I would probably be in there trading it. So, we're being a dead horse, I know. But nonetheless, just correction on the bearishness we've seen this week. Remind you to go back into the earlier part of the week where I outlined what we were looking for, or run below these lows here. We got that. I talked about the euro pound. And no, I'm not trying to save face, but I just want you to go back into understanding what the heart of the week was with this particular week's protocol, where we do not trade after New York Wednesday. No new setups. No trading on Thursday. No trading on non-farm payroll Friday. So we had a lot going for the analysis, and it delivered, in my opinion, satisfactory. Euro dollar 15-minute time frame. You can see we had a small little fair value gap in here. They pumped it up into that this morning, and that more or less topped the market for the day. Took out buy sell liquidity over here, and just consolidated around that old low. Now, I don't see this as a bottoming formation. I see this a very weak attempt to squeeze on shorts, and it didn't really perform like cable has on the upside. So it's still showing its hand as the weaker of the two sisters. So euro dollar, I still think it has unfinished business down below 115. All right, pound dollar daily chart. See a small little bearish order block in here. Trade up into that. today, closed in all the imbalance, which I didn't want to see that, but it's consolidating. So there you go. So we have an indecisive day, opened, dropped up, down, and just back at the opening. That is classic non-farm payroll when there's no directional bias. Hourly chart, pound dollar. Again, just consolidation and pumped up a little bit more into this imbalance here. And to be honest with you, I don't know where this is going to go. I don't have an opinion on cable. I prefer it stays sideways and allow euro to drop. And in 15-minute time frame again, you can see just took a small little pool of liquidity out after running almost into that imbalance on the hourly chart. Just a real ugly day, but technically delivering where the liquidity was. So nonetheless, you can study this old low here, relative equal lows. We took that and just rammed it up into here. Now, when you look at things like this move here to here, you can be fooled into thinking, man, I could see that so obvious. But when you understand the dynamics of non-farm payroll and how much of a carnival ride it can be, nothing says it's going to go up here like that. It could go up here and then drop down 40 pips and then go up there later on, and you're not on it, but you took a loss. That's what can happen. And I avoid that by simply not participating. All right, I mentioned I would briefly talk about euro pound. And here's what we have here. This was the sell-side liquidity pool. I mentioned that when we were up here, it would likely go for that and then maybe reach for here. We ended up getting down to that on Thursday. And then Friday, we seen it trade back to the old low. I think this is going to give way. I don't think this is a low. So I think pretty much this indicates that euro dollar has weakened itself going forward. And while cable ideally should be consolidating, allowing this pair to drop in sympathy with euro dollar and higher prices on dollar index, ultimately this eventually should give way here and trade below the 84.50. All right, brings us to our homework assignment, which was the Treasury bond market December delivery contract month for 2021. Again, going into trading view, you're going to open up symbol ZBZ2021 and take it to your 4-hour chart. Scroll your chart so it looks like this here. Okay, so we have, here's October and all this is September, so about September 12th or so. Show up to the low on the 5th of October, 2021, and the high on the 22nd of September. And we're going to look at this high to this low. Okay, what was the framework? What caused all this? And I promise it will be short, concise, not a lot of jawboning. And any work that you've seen me do with bonds, you'll see that it's right out of the notes I've given you for it. If you have not done the homework assignment, stop the video and then go do it and then come back to it. Okay? Otherwise, you're really cheating yourself. So I'm getting ready to show you now, so you messed up if you let it continue. All right, here's the 4-hour chart, and here's an old high that we traded through here. Notice how we took the buy side here, we took it there and here, and then it took out this low. See that? So this run into liquidity, it's not one singular candle. Okay, there's guys out there trying to say it's an FU candle. No, it's a breaker. So once you have this run into that, if we break through this here, this takes us into a breaker scenario. But notice what happens. We come back down, just take out that low, but it wicks, or in this case, creates candlestick tails. These tails on these candles never really see the body go below that low. Notice that? Really, really important. Because the run back up into here, notice we have this short-term high prior to this high here. So we have this low being taken out after buy side's been taken. The bodies did not take out that low. We did trade through it. Yes, that's liquidity being taken, but it's not really setting up for a bearish breaker to be traded to. In other words, it would have to come down through it and then come back up, and then that could create a selling opportunity on this breaker there. But it's not giving us that. Now, you might look at this and say, okay, well, what about this low here? Wouldn't this be the high, the low, and the higher high? Yes, you can use that, and this would be the bearish breaker in that swing low. Even if that's the case, you're still under that same narrative where the bodies didn't go below that. So you're not saving yourself by that. Okay, so the bodies are showing you the underlying narrative that the volume was not enough to reflect the break of that. This was just taking stops out. Then it runs one more time up, creates a short-term high, starts to sell off, and then rams up one more time. Right here, after the underlying change in market structure, go back to this low, and you can use this low as well. I'm using this one because this is the one that had the most dynamic run away into the buy-side liquidity. And it took multiple candles, not just one singular candle. This low being taken out here is a break in market structure. You do not need the bodies to go below that low to have a break in market structure. A break in market structure and a bearish breaker are not synonymous. They're not the same. This is what distinguishes the two. The low gets traded through. Yes, you have a break in market structure. Why is it likely? Because you've taken liquidity here, broke structure here, and now we're only coming back up to a short-term premium. Here's the dead giveaway. We have a short-term high here ahead of this high here. Then it runs one more time above that. This is a stop hunt on anyone that's going short here. They're gone. Their stops are gone. And then they aggressively break lower, taking out this short-term low. Once it goes through it, notice, does it come back up into here as a breaker? Nope. Does it come back to that old low here? Nope. The breaker's not there. It's just simply a break in market structure. So let's go into this high, down to this low, dropping a fib on that. And if you add your Fibonacci levels negative 0.5 and negative 1, this is basically a measured move from this high to that low. This whole range here has been replicated. Once this low is taken out, it moves that same distance from here to here. It's this low down to that level there. So it's a measured move. So it's a symmetrical price swing. That takes us right into here, which is conveniently right below these relative equal lows, or sell side liquidity, where you would use the concept I teach, which is running down equity, where you every time it takes out a new low and you're bearish, you take out partials, or in this case, you close the position out. This is the lion's portion of the move. This imbalance here, it trades back up to a later time and then goes lower. And then a small little gap in here, it trades up to that and goes lower. But the bulk of the move from here to here, that's enough. You don't need all the, the crumbs. You just need the meat on the bone. There's a small little imbalance in here. It trades back up into that, then breaks lower before it takes out the sell side liquidity pool. I want you to go into this here with me using the 5-year, 10-year notes respectively in comparison to 30-year. So the way we do that is I'm going to show you on TradingView. When you're in TradingView and you have your chart set up like I was showing you just moments ago, you're going to click on the Compare tab here, and you're going to type in ZFZ2021. That's the 5-year T-note futures market for December contract 2021. When you click on this one, or it may not pop up for you because if you didn't really recently look for it, it's probably not going to be in your drop down. But you would type in this symbol here, right here. If it appears down here, or when you type it in up here, you're going to click on New Pane. New Pane will drop it down here. Once it's dropped in, you're going to click on the line chart. And then this little gear here, you're going to click on that. That's the settings for that symbol. And the way you change it is you click on this price source, click it on high, then OK. By doing that, you'll have the chart posted, plotting it on the high because you're comparing highs, relative highs. And you're going to do the same thing for symbol ZN, which is the 10-year treasury. futures contract for December. So, and the symbol is ZNZ2021. Same thing I just explained here. You're going to do it again. Hit the compare tab up here and then plot it and click on the line. Go to the little gear icon, change it to it plots on the high, and then you'll have this here. These little line segments here, I drew that just to accentuate the divergence you see here. Short-term high to short-term high. We took out buy-side liquidity here after a break in market structure. So we don't need this to go above here because it's already done it over there with a break in market structure. So once it breaks down, don't wait for a breaker. It's already done its work. Over here, that's where the breaker is. This is your breaker. High, low, all this choppiness, okay, all this in here, it's high, low, higher high. Two down closed candles, these two. Extend out in time, boom, mean threshold of these consecutive ranges. Split that in half, bodies are showing that, respect there, small little fair value gap there too. Then it sells off. But only after being confirmed that this is a stop run, because you have a divergence in the 5-year. It's not making a higher high when the 30-year did. And the 10-year made a slightly higher high. And you might argue that and say it's the same. Who cares? It's not higher. It's obviously seen here. And it's not lower like it's seen in the 5-year. So this is your interest rate market triad, where you have one diverging. When there's an understanding of what the market should be doing, that tells you that this is a stop rate and or a turtle soup sell. So you can be a confident short seller here. And I know it's scary because what if it goes above here? What about these? Aren't these relative equal highs? No. Isn't this high higher than that one? Doesn't this low being broken here constitute a break in market structure? Yes. Maybe you didn't see it before, but now you know the logic behind it. And this isn't going to be a breaker because it didn't create the understanding that's required for it. The bodies have to go below it. The wicks or tails, that's just showing you a break in market structure. I do not require the bodies to close below a low to show a market structure break. This is your logic for the breaker though. High, low, higher high. Remember, this high to here, it doesn't matter if it has all this jagged up and down. This is still a price range high to low. And this is a high prior to it. So high, low, higher high. Where's the down closed candle or consecutive down closed candles in between this high and that higher high? These right here. Extended out in time. Bam. Everything unlocks. And then we have a distribution to the downside. Hope you found this one insightful. Enjoy your weekend. I'm not going to give you homework tonight because I just don't like doing it. It's my prerogative, as Bobby Brown would sing. So enjoy your weekend. Be safe. And I'll catch up with you on Monday.